All right, we're finally live. Good afternoon, everyone. It's good to see you. I'm Mitch. You're watching my live stream. Be the boss of your money. What is this real deal between these two juggernauts, Microsoft and Google / Alphabet? Why is it such a big deal? And I think it's worth exploring because the dynamics are pretty they're pretty freaking insane. I have to tell you, the more I study up on these two companies, basically, the search business. Well, you know what? I'm going to have to roll the introduction and a couple of other things. We're going to talk about that retail sales spike and Rep. Jim Jordan of Ohio. He subpoenas uh, a bunch of social media companies to explore uh, how much the White House communicates with these companies. I personally don't think he's interested in the previous administration. I think he's interested in the current one. I just that's I think we can all pretty much agree on that. But we're going to take a look at how it could affect these stocks because these companies are so big and worth so much money to investors. Okay. Justin is out there. Justin, nice to see you. Thanks for joining. Listen, guys, if you have any questions about what we're talking about, hit me up in the comments. I love hearing from you. It's the best part about doing this. And if you don't mind, leave us a thumbs up or a heart or an applause, whatever reaction is available to you, depending on which social media platform you're watching from. And, I put a lot of effort into the show. I greatly appreciate you spending some of your valuable time to watch the show. I create a lot of content. Hopefully, you think it's good and useful content. But we're going to get into some important topics. So stick around for a couple of seconds. We're just going to roll a quick intro, and then we're going to get into the heart of the matter. Put my social media icons in here. You can follow me on all of these social media platforms. And here's the intro. All right, if you're just joining me now, I'm Mitch Goldberg. You're watching my live stream, Be the Boss of Your Money. It's a post market wrap up. We talk about the stock market, what happened, the day's big news, some perspective, a little bit about personal finance, and then we get you on your merry way. So the big news, which continues, there's two major pieces of news, in my opinion, that continue to reverberate. What's the best way to say that? Throughout let me get this out. I've had a couple of changes in the studio, so I moved my mic positioning, and I'm like desperate to get this back. Okay, how's that? Try not to cover my face with the mic, with the boom arm. I think that's a little bit better. Okay, what do you guys think? Tell me in the comments. Let me know in the comments. The first big thing is retail sales today were up huge, and it's just another statistic that tells you the economy right now, at least, is pretty strong. It seems to be much stronger than what a lot of people give it credit for. An interesting statistic I noticed that wages are rising faster for the bottom 25% of wage earners than anybody else. But uh, the economy continues to pump along. It's move along. And retail sales, this is a blowout number to see 3%. Now, presumably, there's still about $1 trillion and a half left of unspent stimulus money. I don't know where this number comes from. I really don't. And I don't know who's holding on to all this money either. And there's no evidence that says that this money is going to be spent at all by consumers, except to say that if you give consumers money, they spend it. But we'll see. Maybe people hang on to it for a rainy day. We have to see. Yeah, good luck with that, right? The rainy day thing. So that's one thing. the other thing is interest rates are really starting to spike up. Even longer term interest rates are starting to move up, and the 10-year yield has been very sticky at around 3.5, 3.4%. A couple weeks ago, it was into the 3.3% range, and now it's over 3.7. I didn't check how it did by the end of the day. I was in the city almost the entire day. I did the radio show this morning, and then went to the city and to meet with a client, and it was a very, very good meeting, by the way. If you want to know, I'm getting ready to pull up a couple of screens, and then we'll get into some of the stuff. So retail sales came in strong. Employment figures a couple weeks ago were very strong. 517,000 jobs, low unemployment rate. Now, from what I understand, the unemployment rate typically does not stay this low historically for very long. But historically, we've never had markets like what we have for the last, since 2008. It's nothing has been like anything before. We're just in constant uncharted territory, and I could see people getting a little bit, little fatigued by the drumbeat of news that's always coming out. So it doesn't mean you give up on the market. You can't listen to this drumbeat of negativity that we're also seeing constantly. We might go into recession. We're not out of the woods yet. The market could drop a lot more. We could have a really bad economy, inflation this, inflation that. I hear all of these things. I get it. Highest inflation in 40 years. But you have to understand that 40 years ago and before that, with high inflation, we also had high unemployment. And ultimately, employment is the driver of home purchases. Unemployment or rising unemployment is the driver of foreclosures, late payments, car repossessions. And there's no reason to see that, to see unemployment really rise rapidly right now. Now, I'm not saying it can't rise in a year or two. If you're expecting me to know what unemployment is going to be in a year or two, you're watching the wrong show. Okay, let somebody else give you that, because the world is littered with financial strategists who give these outlandish predictions, and a year later, the one or two who got it right will be on the news for getting something right, and then their next prediction will be wrong and they won't be on the news, and somebody else will be on the news. So I don't really see like consistency in calling big bold moves in the economy. I personally, my own view is the economy is very strong. It'll weaken a little bit to the point where it stays steady. Inflation comes down a little bit, and that is Goldilocks. People say it can't happen. I'm starting to think it can happen. I also think that, we might, we're talking about a soft landing. The Fed raises rates, slows down the economy to bring down inflation. We might not even have a soft landing. On the other hand, inflation is high and bond rates are going up. So maybe we will have a slowdown. We have to see. And that's why the market is so fickle. We have these up days and down days constantly, and futures are down, the market's up. Then the futures are up, the market's down by the end of the day. But if you notice, we've been trading this year all the major averages, the Dow, the NASDAQ, the S&P 500. By the way, you can't invest directly into an index, but you could invest in a security that tracks or mimics an index. The trading this year in the major averages has been in such a small trading range. We haven't had major spikes really up or down. This has been a very calm market. If you didn't follow the news at all and you just looked at the averages, you would think this is like the most boring start for a new year for the stock market. There's just not a whole hell of a lot going on. Now, underneath the averages, there is some action. Disney had a big pop-up. Facebook had a big pop-up. Utilities have been coming down quite a bit. So there's a lot of churn underneath the averages, but that's always been the case. Okay, the averages are, again, just averages of what stocks are doing generally without really telling you what one sector is doing versus another sector. So today we had a turnaround in markets, and the Dow is up 38 points. S&P was up 11. Nasdaq was up almost 1%, up 110 points. Gold off a little. I'm not really I don't really think gold has any significance in terms of forecasting anything. Energy continues to dribble down a little bit. Here it is. The yield on the 10-year, okay, is 3.8%. It's the highest in a while. We saw 4% briefly late last year. It looks like to me not too tough of a call to see the potential of 4% on the 10-year, and that's spiking mortgage rates. But yet the VIX continues to stay under 20 at 18. So the VIX is telling you that there's not a whole hell of a lot of worry in terms of what the market's going to do yet. I hate to use the word yet because it implies that something bad is about to happen, when in fact, I was just saying we don't really know for sure. And while I have you there, let's take a look at all the bond yields. Let's take a look at, I'm just going to make this a little bit smaller for a second. All right. Let's take a look at bond yields. I'm going to get rid of the social media icons also. It's a little distracting to me. Right. All right. Bond yields, okay, we see the 6-month at 5.04%. This is the first time, folks, in 15 years that we saw any treasury bond with a 5 handle. And the 1 year is 4.97. So, and just about there. So three basis points. I'm not really, to me, that's good. Let's just call it 5%. Okay. We're going to round it up. It's a rounding error. But the spread between the 6-month, between the 2-year treasury and the 10-year treasury, the yield curve remains persistently and stubbornly high. But the 3-month to the 10-year is actually shrinking a little bit, the inverted curve there. A lot of mixed signals, but it doesn't all say that things have to be terrible. All right. So yields are up. And it's significant that yields are up because when you buy an investment, you have to compare your investment to what you could earn elsewhere. And when interest rates are zero, well, you could look at crypto or pot stocks, meme stocks, other very highly speculative assets. You say, well, I can't get anything anywhere else. So it makes those assets even more attractive. And what happens is when interest rates went to zero, the most speculative asset plays / stocks became interest rate plays. So interest rates were zero, anything could go up, especially speculative stuff that doesn't have any earnings. That's all reversed because interest rates are actually pretty high now. I mean, you should be seeing higher yields very soon, if not already, like 4% plus across the board for money markets and savings account, if you haven't seen it already. So you have to look at a stock and say, do I expect it to give me at least 7 or 8% before I buy it, because I can get 5% from a T-bill without taking risk of principal. I'll get all my money back in 6 months. When I say 5%, by the way, that is the yield. That's an annualized yield. So if you think you're going to put $100,000 in a 6-month T-bill and get $5,000 in 6 months, you're wrong. You get $2,500 in 6 months. You get $5,000 if you invest it for a year, assuming that the 5% yield will still be there in 6 months. So when the bond matures, you can roll over the bond into a new bond. Okay. There's no guarantee that happens, which is one of the risks of bond investing. But that's a story for another day. So stocks have a much higher hurdle to clear. I think this is good because it'll help shine a spotlight on higher quality companies. And I think it'll cause more investors to pass on speculation, which overall I do think is going to be a good thing. The other thing is that if you take a look, and I see this in particular with the boomer generation, where 65, 70, and older, where these investors were buying stocks for the dividends. So, well, I can't get money in a row, so I'm getting zero in the bank. So I'll buy stocks. I'll get 3% or 5%. I used to have this client, whenever a stock would pay more than 5%, he goes, but he pays 5%. Just, oh, it irks the crap out of me. All those stocks that this guy was getting 5% from are down substantially, but it pays 5%. Yeah, but when you lose like half your money, it doesn't help so much, right? And that's what a lot of boomers did, though. They got into stocks. The stocks were a bit higher because of the dividends. The dividends were lower because they were still competitive with other yields. But now with T-bills, it's 5%. They're giving dividend stocks a real run for their money, and dividends just are not going up fast enough to compensate you for the rapid rise in interest rates. Okay, so that's that. Let's talk a little bit about this whole Google versus Microsoft chatbot thing. We've all heard we've all heard about the artificial intelligence, and Microsoft made a $10 billion investment, which is their third investment, albeit biggest investment, into a company called um, AI. Something AI. It evades me at the moment, but a big artificial intelligence company in San Francisco. So they had a display and it went very well, and the stock went up a lot. So Google, like the same day, announced that they're going to have a demonstration. The stock went down because they weren't ready for it. Somebody slapped some presentation together, um, and that was the end of it. But that's not the end of it. Here's the deal. Okay. So here's the deal. Google dominates search. You know that. 93% of the internet search business is Google. It's a total monopoly. If you've ever heard of a monopoly, that is the definition of a monopoly. Microsoft has maybe 4 or 5% of search through Bing, and then the rest of it is with Yahoo and a few other tiny little players. And it costs money to do search, but these Google gets paid for search. So when you search something for Google, the first links you see are from companies that paid to put their links at the top of the search. And a lot of them are actually just Google's own links so you use their pay engines and things like that to purchase and shop. What the reason people are so down on Google and Google's going down and Microsoft has been going up is because the chat bot artificial intelligence that Microsoft is using is so powerful that they become very competitive with Google and probably puts them ahead of Google. And because of that, Microsoft could actually consume or take over 20, 30, maybe as much as 40% of the search engine business, which is terrible for Google. It's terrible for Google shareholders if that happens. Plus, Microsoft is driving down the cost so much with artificial intelligence of search. Therefore, they're discounting search service that it could crush Google's margins, because now Google is going to have to get competitive and lower their margins or their prices. And that's really why this is such a big deal. But if Microsoft can take a lot of market share in search from Google, Microsoft has a lot to gain, not to mention search would work well with all of their other businesses, LinkedIn, Outlook, all the business software, etc. But Google has a lot to lose. This is incredibly competitive, and Microsoft is bringing down the cost of search, which means they could discount search and become a big advertising company like Google. So it has huge ramifications for tech holders, for holders of Alphabet, which owns Google. Okay, so that's why that's such a big deal. What's next? Well, let's take a look at this. Okay, this is a pretty significant Headline. All right. Um, Key Republican, it's Jim Jordan of Ohio, subpoenas Alphabet, Amazon, Apple, Meta, and Microsoft, citing alleged collusion with the government to suppress speech. Something tells me that he's not looking for alleged collusion with the previous administration, but he's looking for it with the current administration. But if you're looking for collusion with social media companies and government, then just look at it. Go back and look at it, but don't try to pick the time zones, because I have a feeling, and it's already been proven if you watch and look at news, that this crosses both sides of the red and blue spectrum. It's like a purplish thing here, I think. However, having said that, let's take a look at the stocks. The stocks today, Apple was up, Amazon, Google, Meta was off a little, Microsoft off a little, Netflix up a little, Nvidia. Well, Netflix and Nvidia are not really part of this, but up a little, down a little, doesn't seem to make much of a difference. Microsoft and Meta also happen to have gone up a great deal in the last couple of weeks. So I think that has a lot to do with what's worked and what hasn't worked. So it doesn't really concern me too much. And their aftermarket trading, they're basically flat. So I don't think for now that these subpoenas have much to do with the price of these companies. We've seen this before with these companies getting dragged in front of Congress, getting grilled. Nothing happens. Nobody proves anything. It's just these companies basically built better mousetraps, and conspiracy theories are not able to be proven. But we'll see. We have to see. I know this is like political stuff, and I don't want to start arguing with people. We'll just have to see what the evidence shows up. These companies will be subpoenaed, and then we'll have our aha moments. And if these companies are colluding with any political organization, I think it's bad. I don't think they should collude or work with anybody unless it's obviously something dangerous or lives are at stake. I think those are good reasons for it. These companies have policies where they take misinformation off of their sites. So if something is conspiratorial and they take that off their sites, then it's just their own company standards. But it is incumbent upon these companies to apply their standards evenly across the board. And that's what we need to find out. And I would definitely like to know that, because I don't want to be fed anything other than the truth. The other way you can handle this is what Elon Musk says, is just become absolutist with free speech and just let it all out there. Just let it all out there, and people will decide. That's another way to go. I could debate both sides of that argument, but ultimately I think misinformation creates dangerous conditions. So this is going to be fascinating, and I do think that this is the one of the biggest things. Well, I don't want to say it's a very big thing in our lifetime. It really is. It's that big, but definitely one of the bigger things to happen in 2023. And this is going to play out, for months, if not well over a year. So we shall see. So that's the story with the markets today. Tomorrow morning, the jobless claims, first time unemployment claims numbers come out. We'll see what those look like. Those have been trending lower, which means bullish for the economy. And, we're all on the inflation watch to grasp at any straw that says inflation is moderating so the Fed doesn't have to keep raising rates. I don't see anything like that coming up anytime soon. The economy is very strong right now. I hear a lot of soothsayers say by the middle of this year, when stimulus money is out, and we'll start to see unemployment rise. The middle of the year is only 4.5 months away. Where these predictions are coming from, I don't know how people are making these predictions. I hear them talking all the time, and they're like, well, this and that. It sounds like they're just making up shit as they go along. It's just like right out of their mouth, with the top of their head. We just have to wait and see what the world is going to look like. In the meantime, invest according to your risk tolerance, which is established by your time horizon. Okay, don't get over your skis, and do the things you can, the things you can control, like investing in your retirement plan, having money for IRA distributions set aside in cash a year before you need that money. So if the market dips, you don't have to be selling into a down market. Pay down debt. Okay, these are all the things that there's an endless amount of things that you could control about your money. And watching the stock market all the time, unless you're trading, which most of you are not, it's you're wasting your time. So let's focus on the big picture. I thank you for watching, and I look forward to speaking with you tomorrow. Thanks.